Hi everyone, this is Paul Lang from DTS, and I want to introduce to you what you're about to watch. This is a DTS Impromptu event about 30 minutes long on one topic. It was presented live to the free members at Discipline Trading Strategies. It's called Risk Aversion, and I'm going to discuss the effect of risk aversion on traders. Risk aversion is a problem for people in general in the world, and it's particularly bad as we are not wired to be traders by our very nature. Being aware of this can help you with your trading. Naturally, to make money, you have to know how to read the charts, and it's something you can learn at DTS if you don't know how to do that. If you enjoy this, check out the many other educational videos and articles and Trade of the Week videos. You can get access to these at the DTS Free Stuff page. Check it out from the DTS homepage. So sit back and enjoy this event. Welcome, everybody. Wow, that was an impressive echo. Good evening and sound check, everybody. You West Coast people, this is just for you. I have to admit, you guys got a little gypped on some things. Not sure what to say. It's been a debate going on since the beginning of time. Keep the East Coast up till all hours of the evening, or make some of the West Coast miss it if you got other stuff to do like golfing or working. Welcome to tonight. This is a DTS event. This is what I call one of these impromptu sessions. I just started these beginning of the year, actually, maybe the end of last year. I'm doing good, Gary. Thank you for asking. And the impromptu sessions are kind of in between an email. You know, I do a lot of educational emails. You've been getting a lot of them lately, actually. So impromptu session, these are half hour. You had a 1 day notice on this. They're a half hour. They may or may not be recorded. I told you not to rely on these being recorded. I either do an email summary or a recording, depending upon what's easiest, most appropriate, whatever it is. We go through this quick. It's a one-hit topic. I'm not here to take a lot of other questions. So it's a fun, fast little event. And I think this will be a good one. It's a perfect topic for this type of thing because you can't talk about it that long, and yet it's a fairly detailed topic, and you can do more research if you like. So let's go through this risk aversion. I'm going to get right down to it and ask you some questions. I'm not going to do this as a survey. I'm not going to have you punch survey numbers because I really don't care about your answers. What I do really strongly suggest you do, you can type your answer in the room if you want to, but I'm not going to hound you to do that. But what I'd really like you to do is to write down your answers, at least to the first 3 questions, on a piece of paper or on your computer somewhere, because I'm going to go back and talk about them a little bit. I want to make sure that you kind of made a firm decision rather than just, oh yeah, that's what I said. There's no right or wrong to these. It's just to bring out some point. And actually, these first 3 things are just from me. These are things that I think are important. And then I'm going to go to some actual research about human beings in general, which I got from the internet. I'll give you the sites if you want to. All right? You ready to go? East Coast, you still awake? Took your nap, you're all set? All right, here we go. So question number 1, simple question. Which one causes you the most pain? Now, none of this is going to be defined. This is just words. You answer the question the best you can. Which one causes you the most pain? Wait till you get them all. Number 1, you were down $100 at one point when you thought about exiting, but you end up exiting down $300. Wait, how come the arrows all messed up? Number 2, you're up $300 when you thought about exiting, but you end up exiting when you're up $100. Number 3, you're up $100 and you exit, you're down $100. Go ahead, type your answer if you'd like to. Which one of those gives you the most pain, 1, 2, or 3? At least for sure, if you don't want to type on the screen, which I understand, put it somewhere so we can go back and look at it. I'm not going to discuss it now. We'll come back to it in a minute. I've never seen this happen in PowerPoint. Those arrows are not like that on the slides I'm looking at. They're perfectly placed. I don't know how that happened. You know the red arrow here? Not big deal. It's just that, you know, on my slides, obviously it's up here centered nice and pretty. Don't know how that happened. Kind of weird. All right, so actually, for what it's worth, I didn't see you all typing. Number 2, here's the next one. Which of the following is the best way to make $1,000 if you're risking $500? Number 1, you get 2 out of 3 trades correct all the time. This is like an ongoing process, or any day, any week, I don't care. So you keep a 67% batting average, 2 out of 3 trades right continuously. Your winners make $350. Your losers are all assumed to be $1 or $500 losses. So it takes you 15 trades to make $1,000. That's number 1. Number 2, every other trade, I've left it phrased like this on purpose. I know I don't think the English is right. Every other trades are winners. Winners make $562.50. So after 16 trades, you make your $1,000. So here you're batting 50%, and your winner $562.50, a little bigger than you lose your 500. Takes you 16 trades to make the $1,000. Number three, you get 1 in 4 trades correct, 25% batting average. Your winners make 1750, and this again takes you 16 trades to make $1,000. Go ahead and go. Just don't do the math just out of your head. What do you like? What do you like? You don't like making $1,000? You got to say one of them. It's not terrible to make $1,000. I mean, hey, if you're kind of a more active trader, you do that every day, that's okay. So, okay, got 1, 1, 2, 3, 1. Okay. Keep going if you want. I'm in no hurry. Okay. And I'm going to kind of merge into more real life stuff a little bit, but it's still pertinent to odds and trading and everything. So we'll start off kind of easy here. The question is, do you take this bet on a coin flip? All right, this is a coin flip. Do you take the bet, yes or no? Heads, you pay me $10. Tails, I pay you $10. Do you take that bet, yes or no? It has to be yes or no. And some of you may have seen a couple of these things I'm going to go over, they're kind of out there. The first things I'm just doing off my head, but these things are kind of out there. You may have heard of these. Okay, all no's, 100% no's. All right, one yes. That may be what makes you a good trader, Eric. I'm not sure. All right, number two. Heads, you pay me $10. Tails, I pay you $12. Do you take that coin flip? One flip. It says right there, one flip. One flip. Great question though, Gary, because I am going to change that in a minute. Interesting. What was that about? That was about half-half maybe? Slightly more yeses than nos, I would say at a quick glance. All right. Next question. Heads, you pay me $1,000. Tails, I pay you $1,000. Do you take that bet? So same question, just 100 times the money, that's all. And actually, when you get talking about different amounts of money, a lot of this varies on, how wealthy you are to some degree, right? If somebody $1,000, you couldn't take that loss, it would be painful, or somebody else, it's drop in the bucket. But, all right, so, okay, kind of interesting answers there, all right. And then the next one, you know what the next one is, right? You should know the next one. Coin flip. Heads, you pay me 1,000. Tails, I pay you 1,200. So the same basic question, just multiply times 100. Well, this is way more interesting than I thought it was going to be. Of course, I'm not looking at, I can't digest name by name who's saying consistent, but in general, I'm a little surprised at some of the answers. Is that my last slide before I go back? Yeah. All right. So let me go back and review these last 3 slides, and at least for what it's worth. This one here, you guys are pretty split up, right? You're pretty split up, 1, 2, and 3. The point of this that I hope you understand to some degree is that absent any other information, absent a trading plan, absent, doing the right or wrong thing on a chart or whatever, these are all identical scenarios. Every one of these you gave back $200, right? Now there's 2 things there that stick out though. A lot of you did type 3, right? A lot of you type 3, and 3 is a big one in the trading world because it takes you from a winner to a loser. I can't tell you how many people overreact when the screen goes from green to red. But is there any difference? And again, we don't have a chart in mind. We don't have a trading plan in mind. Everything else in the world being equal, does it matter if you lose $200 going from 100 to negative 100, then from plus 300 to 100, everybody? Does that matter? I mean, right? It's $200, correct? Now I understand you could think in your mind of different scenarios and different trades you're in and when it may or may not matter, but it's $200. The point of this slide is that most traders, and this is from me, this is not from a study, this is just knowing this, most traders go crazy over this one, and most of you did, if I remember. I tried to look at it quickly. Most traders go crazy over this one because now, the other one that gets people, and this is the one that actually affects me more, this does not affect me at all. It's amazing though how this affects traders. I've talked with very smart people, pretty good traders, and they just freak out. Now, how does this apply to what we're talking about? It should be fairly obvious, right? I mean, you go to manage a trade, we're managing a trade based on, whatever you've learned technically. I'm not here to teach you that tonight, but whatever you've learned to manage. And you don't all of a sudden go, oh, I'm turning red, I'm getting out of the trade. It makes no sense at all. It makes zero sense. There's no logic to it whatsoever. That's only an emotional response. And this is where the famous get your stop to break even comes out, right? Because break even means you're not a loser. So this $200 means more to most people than anything else. The one that usually means the least to people is this one. Typically, this means the least to people. You got a loser, it's a loser. What do you want to do with the loser, everybody? What do you want to do with the loser? What's your internal, natural human instinct to do with the loser? Well, you're in it. What you want? Well, you want to make it a winner, right? You want to save the patient. You want to get in there and fix it. You want to get in there and take that loser and make it a winner. Well, you maybe should be doing that, Jack. Yeah, right. But I'm not asking you what the correct answer. I'm asking you what your natural psychology as a human being wants you to do. So this is the one that affects people the least because in some sense, in others, if you're really trading, nobody likes dropping $200. But this is the one that affects people the least because it's like, okay, it's not going well. I'll figure out a way to get out of this or something, right? Now this is the one that actually bugs me the most personally, and this is the perfection person. This is I gotta exit at the best number I can, and this one gets me a little bit sometimes. I go up and I just come short of my target, right? And I don't sell, and then this is going on. I'm like, oh my God, what do I do? And then it keeps fizzling away, and that's my biggest problem personally, to be honest with you. But to me, that's number two, right? What'd you say? If that bothers a trader, add a zero to that, since trading bigger numbers is what you want to prepare for. Well, yeah, exactly, Mike. Yeah, obviously, the more money at stake, and that's part of what this test is all about here. Okay. So let's go to the next one here real quick, because again, this is a real quick hit. We're done at a half past, even if I have to stop talking in the middle of a sentence. So this one here, there's no right or wrong. This is a trading style, but most people would prefer this. And I think you guys answered that way, right? I saw a whole string of ones come across, right? Whole string of ones. Why is number one typically the most popular? Why is number one typically the most popular? Yeah, because you feel like a winner. And this gets directly to the problem that so many traders have that are in what I call break-evensville, is that they want to be a winner, so they force the winners by taking smaller winners, right? So they feel good about themselves. And here's the saying at the end of the month. And if this rings true to you, you better stop, take a day off and think about this. But here's what you hear at the end of the month. It's like, okay, I broke even this month, but you know what? Man, I had 65% of the trades right. So I'm doing well. I'll get better next month. I'll hold those winners better next month. But next month you don't. Because the only reason you have the high batting average, of course, is because you're just chipping out small winners, and then you get the losers thrown in and you're back to break even. Now, don't misunderstand me. There's different styles. I have nothing against a scalping style where you're even taking less than 1 hour profits. But here's the bottom line. Are you making money? You have to make money, or it doesn't make any sense. And then number two is just kind of in between. You're just kind of, a 50% batting average is actually, I think, great. As long as your winners are, significantly more than your losers. This is pretty close call. Obviously, you're taking a lot of trades in order to make some money. And this is the one, of course, that scares people because you hear 1 in 4 trades, right, and you gulp. I actually think that this is the most professional style because a good trader can find these. You can take any trade out there that you normally take, and by doing the correct things to it, you can kind of juice it up to a high reward to risk trade. When you do that, of course, it'll have a higher chance of stopping out, but will also develop a much bigger winner. But you have to learn to take those winners. You can't take your 3 losses. I'm sure you heard me say it. You can't take loss 1, loss 2, loss 3, and then when you get to that winning trade, you can't walk away with $800 because now you're losing, right? You got to get that full profit because that's the way your trading style works. I had slides a long time ago that talked about Babe Ruth because he was a home run hitter. Sure, he's great, but he also was a strikeout king. And the question was, what if Babe Ruth, when he hit a home run, what if instead of rounding the bases, he went to first base and then walked in the dugout? Well, according to baseball rules, he's out. So that's my point. Or, if you're going to go for the home run, you got to round the bases when you get the home run. So this is a tougher style for a lot of people and it scares people. On this slide, again, there's no right or wrong. This first slide back here, there's kind of a right or wrong. And the right or wrong is simply, hey, $200 is $200. I don't agree with that line, Jay, at all. I don't know if you're trolling me or if I don't believe in trying to keep your losses small. I mean, it shouldn't be your goal. If that happens, it's fine. But your goal to me is to keep your winners big or in proportion to your losers, or to keep them just big enough but have enough winners, whatever it is. But yeah. And actually, I pick on that line because a lot of traders, I know you didn't mean it that way, but a lot of traders focus on minimizing their losses, which is just dead wrong. You shouldn't focus on that. If that happens to be what happens, that's fine. I'm not against minimizing a loss, but if your goal is to minimize losses, I always say, you'll end up with a whole string of small losses, and that's what you'll get because that's what you're focused on doing. All right. So this one here, this is just a, hey, what do you like? I think as you develop more as a trader, you move closer and closer to this one down here when you can. And part of it to me is just a matter of the style that you develop into and what you're comfortable with. Yeah, well, you're probably referring back to an article I wrote a long time ago about baseball, right? That's actually a great conversation, but I don't really have time to go into it right now. About the difference between a 250 and a 330 hitter. It's amazing when you think about it. But anyways, so and this one here, now this you guys here amaze me a little bit on this one here, and I'm going to continue the conversation from here. So heads $10, tails $10. Well, that's a neutral bet. It's a nothing bet. And we'll see a slide in a minute that says that if you want to take that bet, you're very risk aggressive. If you don't want to take the bet, well, you're just kind of normal because who wants to waste their time? The net gain on heads I win, tails you lose with the $10 bet each way is zero. The net result, the expectancy of that is zero. Now, when you go to $10, $12, logic would tell you you absolutely should take that bet, right? You just should, period. One bet, okay, it's still, logic says you should take that. What's amazing is a lot of people won't take that. I'll get to that in a second. Now, what changed here was we moved the money up. So now you have a higher amount of money. Here, you probably shouldn't take that. I'm trying to just pick an amount of money that's, it's a significant amount. It's like, hey, I don't want to lose that money, right? $10, who cares? So now we're up to a large amount of money. And now here comes a more difficult one. You should still take this bet because the odds are in your favor. You have an expectancy of $60, $100. You have expectancy of $100 taking that bet. But of course, the only qualification you have to say is, hey, is that risk amount too high for me? Is the $1,000 going to make me uncomfortable? Now, here's where you guys got me a little confused. 100 flips. Now we're going to 100 flips. 100 flips, you pay me 1,000, I pay you 1,200. Everyone should take that. Do you know what the odds are if you take this bet right here? If you take this bet, do you know what the odds are of you losing money? Anybody know? No, at the end of 100 flips. Heads, tails. Heads, you get 1,200. Tails, I get 1,000. What's all 50-50? What does that mean? No, it's 50-50 per flip. But at the end of 100 flips, what are the odds you will lose money? If your expectancy is you're making 1,200 compared to 1,000, what are the odds you will lose money? Somebody said near zero and they're pretty close. It's not 50-50. No. It's 1 in 2,300. 1 in 2,300 that you could lose money on this bet on the screen. You follow? Because over 100 flips, it becomes statistically likely it's going to be 50-50, and then you make all that money because every time you're making $200. The more you flip, the more you get perfectly tuned into 50-50. I think at 100, the second standard deviation is plus or minus 3 or whatever. But, right, I know, Mike. Yeah, well, I'm not talking about martingale betting. I'm just saying if you have 100 flips, here's all I'm saying. If somebody offers you this, you take it. Agree? You'd be foolish not to. A lot of you didn't want to take that. There were a lot of people saying, no, I wouldn't take this. And even for the amount, even if $1,000 is a lot to, who cares? You're going to win. It's a guaranteed win. As much as anything's guaranteed. There's a 1 in 2,300 chance I get hit by lightning right now, So that's now what's amazing about this is, and actually I was a little surprised because I assumed in the room here with people that are trading in numbers more, I had some answers I was a little surprised at, to be honest. But here's what's amazing. You ready for this? When done, now this is not me now, okay? This is statistics, and I can give you the sites to it if you want. When done in a mass amount and a variety of people, the average dollar amount required is over $20 before they'll take a bet with a loss of 10. In other words, you go around saying to people, hey, $12 if you win and $10 if I win, and they say no, and they say no, and they say no. On average, they had to get people to over $20 before they would agree to take the bet, paying 10, collecting 20. Do you understand what I'm saying? Now, this is just the average person on the street. This is not a trader, investor, whatever else. The average person on the street. So you go around and you ask people, hey, flip a coin. 15 bucks if you win, 10 bucks if I win. And they say no. You have to get them up over $20. That's mind-blowing to me. And what I'm getting at here is that this risk aversion is something that's built into us. And even if you then went to them and said, okay, fine, one flip, you don't want to lose the 10 bucks. I get it. Let's sit here and do it for 100 flips. Most people still said no. When you're guaranteed to make money, they still said no because of that chance they could lose. And in this case, that chance is 1 in 2,300. Is that amazing? I mean, this was kind of new to me. I knew it in general. I didn't know the 1 in 23. I didn't know this many people. I didn't know that the average person would demand $20 before they take the bet. Isn't that amazing? So Paul, what's the point of this? What I'm trying to get at is that this risk aversion thing is built into you. Well, what's funny though, Stephen, I think some of the people are smart. You know what it is? It's risk aversion. I mean, how can you not understand that math? Jag, here's what I'm saying. If we flip coins right now, okay? And I say, Jag, if it comes up heads, I'll pay you $12, right? If it comes up tails, Jag, you pay me $10, okay? So you got a little $2 cushion in there, right? Flipping a coin is 50-50, right? If we flip a coin 100 times, there's only a 1 in 2,300 chance that you will lose money. That's what it means. In other words, virtually nil. So only a fool would not take that bet. The only issue is, are we going to flip the coin enough that the odds pay out to guarantee me? Hey, any amount of money, I'd take 10. I mean, 10, there's a chance you could lose, of course, but I mean, the odds are overwhelming in your favor. Just generally speaking, if you change the scenario a little bit and say, hey, I'll give you $50 right now. Here it is. Or you can take a coin flip, call it correctly, and get $100. What would you do for that, everybody? Would you put 50 or flip? Would you take the 50 cash or would you flip? Would you take the 50 or flip? 50 or flip? Take $50 cash right now, walk away, see ya. There's 50 bucks for free. Or instead of the 50, take a coin flip and you get 100 if you get it right. Again, technically there's no odds to this. There's no wrong answer. But what this slide is saying pretty much is that if you take that, you're very risk loving. If I changed it and said to you, hey, $40 or flip for 100. If you take the 40, think about it. Would you take 40? Hey, everybody, would you take 40 or flip for 100? What would you do? 40 for free or flip for 100? Because here's where, if you take the 40, you're very risk adverse. If you're willing to flip instead of taking 60 for free, well, then you're very risk loving. Most people are risk adverse, of course. So this is a guy. Now, there have been many scientific tests done about this risk aversion thing, including the coin flip thing. But this is a guy, he's kind of, I don't know who he is. Everybody says he's kind of popular. If you want to watch a YouTube video, this is a guy going around and doing this, asking people, what would you do? And I assume it's not rigged in any way. It's not rigged because, professional college universities have done this test, and it's the same response. And this is just a guy going around asking people live, and it's entertaining because it's like free money and people won't take it. So let's keep going a little deeper, and I just want to, again, get to understand how this is so ingrained in everybody's brain. Take education, for example. A group of teachers in Chicago Heights, Illinois, were told they'd receive, I copied and pasted this, so don't yell at me if there's any errors, receive a year-end bonus linked to student achievement. A second group was given a lump sum payment at the beginning of the year and told part of it would be clawed back if student missed performance targets. The second group, the lost group, saw statistically large different gains in student test scores, while there wasn't an impact in the gain group offered by the bonus. I had to read that twice to understand it, but what it's saying is one group of teachers said, hey, here you are, we'll set up standards for you, and if you hit these standards, you'll get a bonus, right? The other group was given the bonus day one and said, you got to pay it back if you don't hit your scores. This second group dramatically outperforms the first group. What does that tell you? Loss aversion, built in. There's no answer to this when we're all done. I'm going to run past 30 minutes, too bad. There's no answer to this when I'm all done. A lot of it is just awareness, to understand that we as human beings are not built to be financial experts, traders, or anything else. We're built to be safe, right? Save your pages. We're built to be safe. Hey, good. It's 9:28. That's pretty good, Art. That was cute. It is at our core The fear of loss is a powerful emotion for investors, and if left unchecked, it can cost them big bucks in the long term due to years of forfeiture and investment gains. That fear is a natural product of human evolution. This is not from me. These are not my words. I gave you the post to the school thing. Here's this one if you want it, if you want to read some more on your own. The fear is a natural product of human evolution. Our brains are hardwired to detect risks, a useful cognitive tool that helped early humans and their forebears to stay alive. That is my picture, though. I added the picture. They had to evade predators to determine when foods were safe to eat, for example. Fast forward to the modern era, though, and that ancient threat detection and loss prevention mechanism can do us a disservice. We didn't evolve to live in financial markets, says Dan Egan, blah, 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 whoever he is. For investors, the evolutionary impulse plays out our loss aversion bias. The premise, the pain of an investment loss is twice as strong as the pleasure derived from an equivalent gain. Investors have a bias toward avoiding financial loss. Nobel laureates, Daniel, blah, blah. And then this is the preface to that coin toss experiment that I gave you I'm sorry, here's the link to one of those other things I did up there. Here's where I try to, quote unquote, tie it all together. Now try trading. My personal, amazingly, I've not seen any discussion about the most difficult part of handling risk aversion. Before I tell you, can anybody tell me what I think is the most difficult part about risk aversion? When you take all these tests we just talked about, whether it's school teachers getting salary or whether it's coin flips, whatever it is, there's a huge advantage in those tests that you don't have when you're trading. What is it? Anybody know real quick? I have like 10 seconds to give you. It is the fact. Go ahead, I guess some typing here. Eric's going to have the answer. Come on, Eric. If you read fast, you could read. Yeah, it's phrased funny, but yeah, outcome is based on, I think you guys have it, is that we don't know the actual odds, right? Everybody? We know a coin flip is 50-50, right? We know a dice roll is whatever it is, right? We know all these odds. You even go to the track and, there's odds on what a horse is, whether it's right or wrong. But when you say, what is the chance of that trade you just entered moving 70 cents? Do you know a statistic for that, everybody? Can you say it's 62.4% chance it'll make it there, anybody? Yeah, and think about how that plays on you, right? That unknown quantity makes it extremely difficult to trade because how do you now assess risk and risk aversion when you don't know for sure what the possible reward even is? And by the way, as you know, there's a book I like called Trading Your Way to Financial Freedom by Van Tharp. It's on, I put it on the website, I'm not for sale, just put a mention of it on the other stuff page. And if you ever heard me talk about it in detail, it's a great book, but there's one thing I've always had a little bone to pick with Van Tharp about, and that is this topic actually, is that he, in his expectancy concepts, he's always assuming that we have a good handle on what the odds are of any trade, because he's using a method type, he's using a system type based trading concept instead of a method based. So we don't have that advantage. It's kind of a circular argument to try and do that. So amazingly, it's difficult enough when you know the odds. In trading, we don't know the odds with precision. The better the trader you are, the more you get that confidence. But how do you know you'll get to point A on a chart? You don't know. The unknown makes things tougher. The more you know, the more confidence you have, and the more your intelligent brain can play out the odds, right? Think about the unknown. The unknown really challenges us. And if you're a newer trader and you look at a chart and you're just kind of guessing what's going on, how do you assess the odds, right? Correct, everyone? So here's the gratuitous trade scene. You know how movies have gratuitous sex scenes? This is a gratuitous trade scene. And actually, sorry about that, but actually today was a perfect example. Perfect example today. TAL today. This is the trade I did today. You guys are in the room, Art's here. Highly rated gap and a fortune of entry. Now what? Now I'm not showing you today's bar. We're gapping to right here. I consider this a tier 2 gap, meaning top focus for the morning. Want to get into it. I'm not showing you the daily bar today because I don't want to give away what it did. So let's come down, and by the weekly chart was in play in here on this one too. This is actually also a long-term position I have in the long-term trade, but today was a day trade. So what's going to happen? So here's the 5-minute chart, right? And just understand this gap to right here, in case you're lost. There's the daily chart. It's gapping to here. We knew that. Staring at this at open, boom. It gaps up pretty much. And my comment here was it gapped both just enough and a lot. That's the problem with gaps sometimes. Kind of wanted a bigger gap to get it going, but also was a lot, makes the entry. So initially took off. I'm just watching it and thinking, okay, I may have to miss this one, right? But I was hopeful, it says. Number 2, we didn't pull back. we came crashing in. This came in kind of crazy. Now, normally I love this and I will jump on this when it comes crashing in, but this is even a little crazy for me. I mean, it was really all over the place. So I decided to wait. I made that decision, and this is a decision you have to make as a trader. Take it, or am I okay if I miss this trade? I was okay if I missed this trade. And then I put my next line here is, thank you, trading gods. Comes back and gives me a great little entry. Got the entry, had to give it some room, more than I wanted to, but it worked. Bigger target was in mind, so it's going to be okay. So now here we get to the question of today, right? You're in this trade. Where's the target? Where are we going? What are the odds I get to that topping tail? Anybody? What are the odds I get to the high of the day? Anybody know the answer? What are the odds I get to the prior high on the daily chart from 2 months ago? 50-50. So we run up, and my next comment here is, now what? The daily chart is not much of a help for a target. Here's the daily chart. We're opening here. What am I doing? Going all the way to here? That's a whole $1 away. That's a lot for it. So where's my target guidance? I don't have any. So what do? Well, high of the day sounds nice, right? So I took it all at the high of the day. No, I didn't. Just joking. Didn't take anything at the high of the day. Now, why didn't I take anything at the high of the day? That was a decent target. Why not take anything? I took nothing. I still have the question then, okay, well, where are you going to take some? Why didn't I take something at the high of the day? And I'm not really looking for an answer from this chart. I'm looking for more of a theoretical answer. Why didn't I take some pretty good profit at the high of the day? It could have come crashing down, right? Could have come crashing down, and I would not have been happy. Yeah, Art said higher, that's right. Yeah, whatever you're saying, though, I can wait for a reaction. But Mike, the reaction, though, right, the reaction might have been this. That might have been the reaction, right? So you have to make up your mind. For me, my chart knowledge, I have to deduce. I say, you know what? This is a high odds thing. It's going to go much higher. That's all. That's all you can say, right? I can't tell you the percentage. Yeah, weekly uptrend, but yeah, who cares? Every other chart's a weekly uptrend. Every chart's a weekly uptrend, you know? It doesn't determine how high it's going to go. Matter of fact, if you gap in a weekly uptrend, it's actually somewhat of a negative, but this is a brand new weekly uptrend just started. So my point of all this is that, you know, you're flipping coins, you're rolling dice, you know the odds, and you should be able to figure out, like you play blackjack, you know the odds, you should figure it out. There are no odds on this. The only odds I have come from the skill that I have as a trader, from understanding charts. Is that true, everyone? Is that true, everyone? The only odds are the ones that I can make up in my head from my own skill. And I'm not right all the time. But this to me was a great gap. And I didn't want to sell it out for a 1 hour profit at the high of the day. So here, I did take a first target there. Why? I trailed, as this bar came to the top, I set up a little trail right underneath it. Why? Why there? Reason? Well, if you go back and look at the daily chart, we actually are making it to that, you know, that topping tail from 2 months ago, right? And the other reason is this little bit of acceleration, right? And one of the biggest bars on the chart after 29 bars up. And that's your indication, right? That's your indication to say, hey, even if you don't know, when I teach class, which some of you come to, I teach a concept that says we don't know the target ever. Nobody does, right? But I know the zip code. And it's kind of like the red zone in football. When you get in the red zone, you set up a different defense, set up a different offense. It's a different game. Well, when I get in the zone, zip code target 1, then I do something to protect money. So that was the zip code to me. And then you see the reaction. You get the biggest bar in the chart. So I protect something there. So that's the reason for number 1. And then number 2, I took number 2 right here. Why there? Well, simply because we hit that daily area, and underneath here I trailed it out. I thought that doesn't look right to me. Yeah, that's not right. It's here. Here's where I took it. That arrow's wrong there. Because, well, yeah, I scaled that. I usually take 3 targets, and this one I took 2. Actually, I think I was originally going in thirds, but I made it half when I got this high on the chart. And the reason for taking it here, and again, forgive me that this arrow is wrong. It should be here. The reason I took it here was because we barely made a new high. And look, I got pretty much the high of the day on a record daily bar. So just lucky today, and something nice to show you that's exactly in line with what I'm teaching you and telling you. How many traders scalp it out for an okay profit but leave the most behind? Well, you can always say, great, I took some profit, that's great. But to me, different setups have different entries, different concepts, different targets. And when you get a really nice setup, you got to try and take it for all you can. Not every chart's like that. So that's where to me, my final comment here, and we'll go, to me, and I think a lot of traders agree, your typical week as a day trader is not like every day, every trade you do the same thing. There's different opportunities every day. There's some days that get you. And to me, I usually find that if you have a good week, you usually have a really nice day, a second pretty good day, one maybe losing day, and a couple what I call McDonald's days. That's just the way it plays out. And to me, the secret to trading is to watch which day. Big winning day, okay winning day, losing day, McDonald's days. McDonald's days means just you're up or down a little bit. Which are the deadly days for most traders once you get going? Of those three. Big winner, okay winner, losing, McDonald's. Which is the problem day for most people that you have to keep an eye on? What is the account killer for most people? It's never the one you think. Yeah. No, everybody has big winners. Brand new traders have big winning days because they're aggressive, you know what, to the wall. It's not the losing day either. Initially, Jag, it is. Initially, it is, but guess what? You take a huge losing day, unless you don't have a brain cell in your brain, you stop doing that, right? So once you get going, big winners come, big losing kind of, you know what they are? It's the McDonald's days. Think about it. It's those McDonald's days. It's those days where you're trying to make some money and you're just up a few dollars or you're down a few dollars. There's nothing to do, but what do? You can't stand being down $100 for the day, even though you're risking 500 on a trade, right? So what do? You go searching for another trade because you just want to make something that day. You can't walk away saying, okay, just a nothing day, I'll come back tomorrow. No, you got to do something. And it's you do another trade and then you lose. When you lose, it's already past the time you want to be trading. What do you do when you lose one? What do you do when you lose one? Everybody, when you lose, you were even, you had to take a trade like an idiot. You lose. What do you have to do after that? What do you have to do? You have to get it back, right? Now you're like, darn it, I wish I would have stayed where I was, and now you got to get back. And now you're down two. And this is what I mean. Your McDonald's days turn into losing days. That's the hallmark of the bad trader. Winners and losers, you handle. It's the in-between days you got to learn to say, hey, I tried, nothing out there today, see you tomorrow, right? Yep, absolutely, Gary. All right. Hope you enjoyed that tonight, folks. Quick little one-hit topic. I did run over. I tried my best. All right. See you in the room tomorrow, guys. Happy Friday. Have a good weekend. See you in class if you're in class Saturday. Take care, everybody.